I want to keep talking sports, but this would be a bait and switch. We had like I think almost 200 people sign up for this room. The room's filling up. So if we go on for New York sports, I think people are going to start tuning out. So let's get to the matter at hand. So I put out the clickbait title, but I took it from your feed. Stocks are no longer a leading indicator. So I'm going to turn it over to you, Eric. You can go with that or anything else you want to talk about. I mean, there's just so many different directions we can go, but I think that's I think it's a very provocative title you have. Stocks are no longer a leading indicator, so maybe we could start with that. Or if you want to put it in context and talk about something else first, that's fine. But I'm going to turn it over to you. Take it away, Eric.
Sure. So what I'll do is I'll quickly just touch on the process that I use, and then I'll go into stocks as a leading indicator or lack thereof. For anyone that wants to follow some of the charts that I'm talking about, the pinned tweet in my profile links to a Substack article which dives into the leading nature of stocks over time.
Right, Eric. I will be sure to put that up on the nest. Keep going. Go
Sure.
ahead.
So, I follow business cycles, primarily the US business cycle. And business cycles follow a particular sequence or order of operations that has remained the same for decades. You go back to the 1950s, 60s, all the way through today. The sequence or the order of operations in which the business cycle unfolds has remained the same the entire time. Now, the lead and lag times between various stages of the business cycle are variable, sometimes long and sometimes highly variable, but the order of operations is the same. From a very high level, we follow what we put forward as a four economy framework. We call it there's basically four separate economies. First, we look at the leading economy, traditionally just called leading indicators. And in that bucket, you don't measure any growth or employment. You're only measuring monetary and credit variables, as well as soft commitments, things like permits, new orders, contractual obligations. You're not measuring any growth or employment. That's the leading bucket. Then you move over to the cyclical bucket. And this is the first time that you actually measure growth and employment directly. But we're only measuring it for the residential construction sector and the manufacturing sector. The reason that we focus on those two is because they're the most volatile, interest rate and credit sensitive parts of the economy. So, virtually by definition, those are the sectors that have to respond first to any tightening or easing of monetary and credit conditions. Once the downturn or upturn, but in this case, let's just say downturn. Once the downturn becomes deep enough and persistent enough in the residential construction and manufacturing sectors, it's those people who become unemployed that then put the stress on the third bucket, which is what we would call the aggregate economy. The aggregate economy is what most people follow. The Federal Reserve, financial media, and most high level market conversations are surrounding things like the unemployment rate and consumer spending. Those are things that we would bucket in what we would call the aggregate economy. Finally, is the fourth bucket, what we call the lagging economy, and that's primarily measuring growth and employment of the services sector. For the sake of asset markets and asset allocation, that fourth bucket, that lagging bucket, is not highly relevant because by the time things show up there, it's extraordinarily late. It's already late enough to focus just on the aggregate bucket. But when we use that framework, everyone focuses only on the aggregate bucket, and we constantly hear the consumer is still spending, the consumer is still spending. Those are all aggregate economic statistics. And again, by the time those turn down, you've already had a substantial and long downturn in the cyclical economy or the residential and manufacturing sectors. So when people say stocks are a leading indicator or stocks move the economy, what they're really saying is that stocks turn down and then you see aggregate statistics like consumer spending turn down. But that misses the point that by the time those stocks turn down, they don't just spontaneously combust. They turn down because there was pre existing pressure pre-existing unemployment, pre-existing margin degradation that's already been in place in the more interest rate and credit sensitive sectors. So in the pinned tweet in my profile, I'm showing the three most modern recessions: 1990, 2001, and 2008. And I'm showing the cyclical index that we use, which is a combination of growth and employment for those cyclical sectors that I mentioned, peak before S&P 500 earnings. In the case of the 2008 recession, peaked way in advance of the 2008 recession. So it's not accurate, in my view, to say that stocks are a leading indicator when there's so much economic degradation that happens before earnings decline in the big cap indexes and then before those stock prices tend to fall. The last point that I want to make, and sorry for dragging on here, is that this nature of stock prices becoming less and less of a leading indicator has expanded over the years. When you study business cycles and leading indicators in the 60s, 70s, and 80s, stock prices, particularly the S&P 500, was grouped as a leading indicator. And the reason for that is because the index was primarily comprised of these cyclical type companies, industrial manufacturing based companies. Today, the major stock indexes are very lightly focused on these cyclical sectors, and they're very heavily focused on mega cap, conglomerate, monopoly like, service oriented companies. Lastly, the passive flows, which are generally just a derivative of the labor market, have become an increasingly large share of the market as compared to active management. So those phenomenon all put together are making stocks increasingly less of a leading indicator. And you could see in that three-panel chart in my profile and hopefully in the nest that as we've moved from even just the 90s to the 2000s to the '08, that leading nature of stocks is becoming less and less, and that cyclical economy, the cyclical construction, manufacturing sectors, those really do move well in advance of broader economic conditions, despite the fact that they've become a smaller share of the overall pie.
So Eric, boy, that's quite a lot to absorb. So what's an honest speculator supposed to do? Because the information content and stock prices, at least real time, is you're pointing out, there's more of a disconnect. I mean, there's the old saw that the market's not the economy's not the market, blah blah blah. Well, what you're laying out is even a stronger case for that. So, what are you supposed to do? Is there something you look at in all this? And Dave, we'll get to you in 1 second. Is there something you look at in all this, or one part of this, Eric? You look at a component, just a cyclical part, or something like? How do you use all this to formulate your investment strategy?
So I every month and every week we update this four economy framework that I'm putting forward here, where we can look at exactly what's going on in the leading economy, the cyclical economy, the aggregate, and the lagging. And we can see when there's a downturn in the leading, a downturn in the cyclical. And the way that I would use that process now, it's really dependent on who you are as an investor. And we work with both hedge funds, private equity firms, as well as a lot of corporate management teams of manufacturing and construction companies. So we work with a lot of companies that aren't, staring at the stock market every day, but trying to use these business cycle dynamics to make actual business investment decisions. These companies turn large ships. They can't move in and out of the market every 5 minutes based on somebody's tweets. So what you have to do is you have to look at the sequence in which the economy is unfolding. And when you see downturns, let's say, begin in the cyclical economy, which has been the case over the last 2 years, what you see is that cyclically oriented assets start to perform poorly. So, our cyclical economic index, again, a composite of construction and manufacturing, both growth and employment, peaked at the beginning of 2023, January of 2023. And we sit at a level today that's the same level as we were in 2022. The downturn has not been super extreme in terms of magnitude, but it's been long in terms of duration. And when we go through various asset prices, we do see that they line up quite closely with the contours of that cyclical economy. So, for example, again, this would be in the article that's linked in my profile. The Russell 2000, small cap, more interest rate sensitive, doesn't have the monopoly characteristics of the S&P 500. Same level today as it was in 2021 and 2022. Green Street Property Advisors, I believe is the name of the company, they publish commercial real estate prices for all different sectors, from offices to apartments to self storage. Pretty much the entire commercial real estate sector, even apartment buildings, have peaks based on their data in 2022. Again, very much lining up with the fact that the cyclical economy rolled over at the beginning of 23 and is at the same level today as it was in 2022. You look at some emerging markets, lower today than 2022. Some emerging market or cyclical currencies, lower today than 2022. You look at the front end of the treasury curve, like the 2 year treasury, it's gone on it's had this long rolling peak where it went up, and we're at a level today that's again pretty consistent with where we were in 2022. What's really bucking that trend is the S&P 500, the Nasdaq, the companies that are very monopoly like in nature, that are much more tethered to that aggregate economy or lagging economy. Those continue to perform well, and they will continue to perform well until the downturn gets deep enough in the cyclical sectors that it begins to drag the aggregate lower. So, to answer your question, the way that I would use that process is, once I see a downturn spread from the leading economy or leading indicators into the cyclical, you have to be careful of which assets that you're allocating to, or if you're a business in those sectors making investment decisions, because large swaths of the market will perform poorly, the ones that are more tethered to those cyclically oriented sectors. And this is why we've had this large bifurcation in asset markets. This is why we've had this large bifurcation in Wall Street versus Main Street, because so much of the economy is tethered to the goods economy of construction and manufacturing. Many companies are more tied to that part of the economy. They are suffering under these interest rates. They are suffering under what's a prolonged yet mild slowdown. If you talk to anyone in the manufacturing sector, they say their business has been down for 3 years, all very consistent. But you can't just say, as soon as the cyclical economy peaks, I'm going to short the S&P 500. That's not the way to use the process. You really got to look within asset markets to find the parts of the market that are much more tethered to the cyclical parts of the economy, and those are the ones that you'd want to avoid first. And then the more defensive companies that are more tethered to aggregate and lagging and services type, those will turn down far later. And
So,
since we have no downturn in the aggregates yet, those will continue to probably
like,
perform just fine.
so that explains, for instance, you look at small caps. Let's just take the Russell IWM, which generally speaking is poor quality, lower margins, a lot of earnings volatility, worse balance sheets, etc. You juxtapose the position of that with, let's not compare it to Mag 7, that's unfair, but if you were to take a high quality index of some sort, companies with strong cash flows, moats, et cetera, lower earnings volatility, that trade has just been printing and printing and printing. And from what you're saying, Eric, it sounds like you'd still be inclined to see that continue, no?
Yeah, very much so. I think that that is exactly, and that's, by the way, that's a secular phenomenon as well.
Right.
That's been the case for the last really 15 years, and there's a variety of reasons for that. But on a cyclical perspective, I think that that will continue as well. So secularly, I do think that the large caps will continue to outperform the small caps. Cyclically, I do think that's the case as well, given that the economy is turning down and has been turning down in the cyclical sectors for the better part of 2 years now. That is going to continue, although the magnitude may be, still quite mild. But as long as we have that bifurcation where cyclically oriented sectors are turning lower, but aggregate statistics continue to do quite well, you're going to have that dynamic where anything that's, like you said, poor quality, that's just not, really tied to those services and monopoly like in nature, are going to struggle in comparison.
Someone should go get Cancho. He's got a new best friend here. David, so I see you and your good friend Deer are here. Eric seems to be kind of in your sandbox to a lot of stuff you guys talk about. So, David, I don't know if you wanted to weigh in or had a question for Eric, or maybe Deer wants to ask something. So, David, what's on your mind?
Yeah, so I do have a little question here, and specifically around consumption rates. I see that I'm going to quote your current statement here. For this reason, if you only focus on aggregate economy indicators like non-farm payrolls and personal consumption, it is impossible, sorry, to be ahead of the cycle. You can only tell peaks in hindsight. The reason I bring that up is I'm just curious what your ideas surrounding personal consumption and just consumption rates on aggregate within the economy actually impacts it, because I know George goes off and says obviously, and I agree with the statement to a certain extent, but the stock market is not the economy and inverse. But I think that the stock market is related to the economy, obviously, just due to consumption rates. And I was just curious your output for consumption rates and how important it is for the actual total picture.
Well, it's obviously extremely important just given the size. And if you have a downturn in consumption, then the rest of the economy is going to turn down. What I'm really trying to point out is that the if you look at the total personal consumption, which we know is 70% of GDP, so much of that is service oriented consumption. And within that, you have things like healthcare spending. And all of those things often don't ever turn down, don't ever contract, even in recessionary periods. So I don't know exactly the date off the top of my head, but I think personal consumption peaked in, maybe the first quarter of 2008. But you don't know that that's a peak until maybe the second or third quarter because you have to look to see where the data goes to see that there's a peak. So, that's why there were, if you go back to some of the transcripts in the summer of 2008, you had people like the Federal Reserve and a lot of market commentators saying that consumption is still strong. There was a strong retail sales print, for example, in like the second quarter of 2008. And many people said the economy's doing okay because the consumer is still holding up just fine. But you had 2 years of extraordinarily aggressive declines in construction employment. You had lost over 1 million jobs in construction at that time. So I just don't find it to be a useful indicator for forecasting the direction of where the economy is going. But as far as it as an indicator for the health of the economy, it's the most important, just given its size. And then you could break down consumption into various components. And if you wanted to do that, then you could get a much better picture. So, for example, the durable goods component of consumption is what you'd want to be focused on as far as a more cyclical indicator that would contract ahead of broader consumption. Because if you look at healthcare services or prescription drugs, all of that falls under consumption. And there's just those things just aren't going to turn down even in recessionary periods. So I would look to more narrow segments of consumer spending if that was an indicator I was going to focus on.
Well said, Eric. Eric, um, if we just talk about consumption um, and real incomes, and I guess there's lies, damn lies, and statistics, and there's government statistics. Okay, and we know we're in this K-shaped economy where those at the top have done pretty well, and those at the bottom haven't, and the ones at the bottom are getting squeezed, and the ones at the top at least weren't getting squeezed. Maybe they're starting to get squeezed right now. But when you look at real income, and we still have job growth, we haven't, layoffs may have picked up, but we still haven't shed jobs to any great degree, if at all. So jobs are still there. But I don't know. I don't want to get into narrows and feelings. But so instead of prefacing the question, I'll just ask it. What is your outlook for consumption going forward, given all the various pressures, be it interest rates, up, oil prices down, food prices up, the dollar down, et cetera, et cetera, et cetera. So the consumer itself, how does it look to you? Or again, is it a bifurcated scenario?
Sure. So we focus on the cyclical economy first. The cyclical economy, again, being growth and employment of construction and manufacturing primarily. When we look at that situation, we have a peak in 2023, and a very mild slowdown. But if we get a little bit more granular and we break down the cyclical economy into its growth or production components and its employment components, what we see is the production components are falling very aggressively, but the employment components are not. So when I mean production, I'm saying how many units are we moving off the manufacturing floor, or how many apartments are we building, or how many single family homes are we building? That would be production. And then employment is how many people does it take to produce those things. So in that cyclical economy, production components are falling, employment components are not. Take the two of them and you put them together to look at the whole picture, and you have what looks like a very mild slowdown. But because employment is the most important component, and that's what ultimately impacts consumption, and we haven't seen aggressive declines in even the cyclical components of employment, there's not a gigantic risk for broader consumption in the next couple of quarters, let's say. Consumption will start to be at great risk when you have a more pronounced downturn in the employment components of those cyclical sectors, because it's those people who become unemployed that then pull back on consumption and create the downstream stress in the economy. Those
Right.
people create the delinquencies on credit cards and auto loans and student loans and all of those types of things. But you're not going to have that appear until there's a downturn in consumption. I mean, in employment,
Right.
excuse me.
So let's just drill down a little further. Um, so the fact that headcount hasn't fallen, there are a lot of reasons, narratives to why it's the case. It's increasing uncertainty going forward, or it was so hard getting labor last time around the track, and therefore if you shed labor, God knows you're going to get it back. Blah 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 blah. So if you tell me in that goods producing part of the economy, output is falling, but headcount's flat. Let me do my Columbo routine. So wait a second. That means margins are going up or down. Sorry to be a wise guy. The question. Like, how's that not bad for profit margins in that part of the economy?
Well, that's a pretty good point that you make there, and this is something that we've been harping on pretty aggressively in our client reports. So we look at economy-wide profit margins for the entire economy, but more importantly, given my focus on the cyclical sectors, we're looking at profit margins for the residential construction sector and the manufacturing sector. And I have all these charts in my latest report. In the residential sector, profit margins on average were 10% before the pandemic. Because of the aggressive stimulus and a whole host of factors, profit margins in the residential building sector were pushed to almost 20%. We doubled profit margins in the residential sector. Um, Profit margins were pushed to the highest level in history in the residential sector. Similarly, we had about 10% profit margins in the manufacturing sector. This comes from GDP data. That was pushed to almost 16% after the pandemic for a variety of reasons. So we had a 10% increase in profit margins for the residential sector and a 6% increase in profit margins for the manufacturing sector. As you correctly pointed out, if you have production that's falling but headcount that's staying flat, the difference has to come out of margins. So margins peaked for both of these sectors in 2022 when this really long but slow slowdown began. And we've seen margins in the residential sector fall from about 20% to 15%. So there's been about a 500 basis point drop in margins. And we've seen margins drop in the manufacturing sector from 16% to 12%, about a 400 basis point decline. The margins are compressing in those sectors. However, we're sitting at about 15% margins in the residential sector now, which is still 500 basis points above where we were going into the pandemic. And we're sitting at about 12% in the manufacturing sector, which is 200 basis points above where we were going into the pandemic. So there's no secret sauce as to, when margins get to 11.23, then everyone just immediately sheds their labor. It's not an exact science. We have seen margins rolling over in both of these sectors. Companies have taken initial steps to protect margins. Those initial steps that companies take, we aggregate into what we call a leading employment indicator, the steps that companies take before they get rid of headcount. And those are all the traditional things that we mostly know. Um, they freeze hiring, they reduce hours worked, they pull back on permits and new orders and capex, and they get rid of temporary help labor. All of those things they're doing. We have extraordinarily low hiring rates in residential and manufacturing. So companies are taking all of these initial steps to protect margins, even though margins are substantially elevated from where they were before the pandemic. So as the Fed stays tight and refuses to cut interest rates, and they keep putting negative economic pressure through that sequence, you are going to see production continue to decline in the manufacturing and residential sectors. As companies continue to try and hold their headcount, you will see more margin degradation, which the stock prices may not like. If you look at like the ITB Home Builder Index, that's down, I think, maybe 30%. And this peaked, I would like to remind everyone, before Trump got elected. I think it peaked in October of 2024. So it's the stocks there are picking up on the decline in margins, but there's no immediate sign that they're going to relinquish large amounts of headcount in the next quarter or two, given that they still have what looks like a decent cushion above where we were just a couple of years ago. Again, it's not an exact science. They may relinquish headcount at a higher level this time than they have in the past. They may relinquish it at a lower level. We don't know exactly. All we know is the rate of change in margins is coming down. They've pulled a bunch of early levers to try and protect those margins. If margins continue to compress, then employment will become a greater risk. And then once that occurs, now you have a bigger risk for aggregate statistics like consumption to start really coming down.
It's really well said, Eric. And I'm trying to find a tweet that I had a couple weeks ago from Albert Edwards, and you probably have the same type of data that he has, but he was showing profit series for the U.S. economy, widespread, writ large, and you know the graph. It just shows margins going to levels that are just never seen before, like clearly over earning for all the reasons you laid out. And if we're in this, continue to be in this environment that you described, and there's no, monetary largesse, to the contrary, I mean, I think there's a lot of reasons why there wouldn't be. And if we're more likely to talk about cutting spending, not increasing spending, it just seems that profit margins, destined to decline. And people look at PEs, and sometimes they don't. The PEs are back. They're backward looking, and so I don't know. To me, it's just you're baking in the cake a lot of earnings disappointments going forward. I mean, that's my processing of what you're saying right now, Eric.
Yeah, I think that's fair. I mean, again, you're seeing the margin degradation first in the cyclical areas like residential, like manufacturing. Um, it's pretty clean to roll up the margins from the publicly traded home builders because they have a pretty narrow business focus of just building homes. It's not that clean to try and aggregate manufacturing margins from publicly traded companies because most of them are conglomerates. So I like to look at the manufacturing sector through GDP data, which tends to be a little bit better because most of our true manufacturing businesses are private sector. So I think that you are setting up for a lot of disappointments in those more cyclical areas. But again, I don't think that the large tech companies are at as much risk yet. And the
Right.
reason I say that is just because they, in my opinion, have many monopoly characteristics that will allow them to continue earning until there's outright declines in the aggregate labor market, which is not something that's immediately in front of us, although there are definitely storm clouds on the horizon pending more, more declines in the cyclical areas of employment.
So that makes sense. That would explain why these stocks in the main have continued to outperform the broader equity indices, correct?
That's right. So when I say stocks aren't a leading indicator, I of course referring to the S&P 500 because that's what most people think of when we say the market, right? But you can get a little cute and look at various different sectors. And if there was one sector that I think could make the case for a leading indicator, it would be the home building stocks. And those stocks have I think they're down maybe 14 or 15% year to date. They're down 15% over the last 1 year, um, after performing extraordinarily well. Should point that out as well for a number of years. Riding those margins up from 10% to 20%, but now that is reversing. So, watching the home building sector of the stock market would probably be one of the only areas that I would take seriously as stocks being a leading indicator. I just avoid the S&P 500 as a leading indicator because it has so much influence from the Mag 7, and those are really, really not cyclical, um, businesses in their current form.
That's a very insightful observation, but I find it also very disheartening because it leads into sort of a narrative I've been running with in my own head. Everyone can talk about we'll have a recession, we won't have a recession. People argue about, oh, it's not a recession because there weren't two consecutive quarters of GDP decline. And then going back to the top of the hour when we are kidding about sports, it's like, well, look at the replay. Actually, based on the revision, we go to Secaucus, New Jersey, and the Bureau of Labor Statistics has decided that technically it was a recession. Oh, okay, that was really helpful after the fact, right? But,
Right.
but so it always does backward look at all this nonsense, right? But the question I would ask, here's a serious question here. Forget about whether your GDP's numbers bigger than mine or smaller than mine, or the dot plots, or the jolts, or all this stuff, right? Well, I kind of want to. What really I find fascinating, what you said, is the duration of what we're looking at. I.e., okay, so let's say we don't get a recession as technically defined, but it's kind of like blah. But given just as you've been talking, up until now, we've had this peaking and it kind of sliding down, but no, real collapse in economic stuff. What if it's just we go and I know and John Ruck always says don't try to look around too many corners. It's hard enough getting like the next few months or year correct.
Right.
But if you had the spitball and I say to you, hey Eric, come on, look, we spent money like it was going out of style. It was never spent in the history of the world. I mean, that's true US exceptionalism, our budget deficits, right? Margins went to like all-time ridiculous places. We had incredible monetary response to COVID, blah, 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 blah. They'll all conspire to give a major blow off top in margins and valuations, all that kind of stuff. And now the water's kind of just leaking out of the bathtub. So the question, I guess, is like what? So okay, so we get a recession, we don't get a recession next couple of quarters. I don't see where the growth comes from. I don't think you're going to see ample liquidity. I still think inflation is kind of a problem. I don't think you're going to see a lot of liquidity put in the market. And clearly, you're not going to see an acceleration in spending. I mean, we haven't presented any austerity yet, but it's hard to see spending accelerates from here. So to me, it just kind of adds up to like margins are going to kind of look to be like kind of. I mean, leaving the Mag 7 out in the general scheme of things, it's more the duration of this sideways downturn more than the depth of it. And so, how would you think about that?
Yeah, I think that's exactly right. It's been a particularly unusual environment because it has been the longest non-recessionary downturn if we're looking at the cyclical sectors, which is the most important. Again, those um, that index that we use, that we aggregate for the cyclical sectors, peaked 27 months ago. Even though it peaked 27 months ago, the whole index is down just a little over 1% from peak. So we've had basically a 1% contraction over the last 2 plus years. Like a basically fraction of a percent per month. Like you said, it's just leaking extraordinarily slowly, which has allowed the aggregate to continue doing quite well, which has allowed the major indexes to continue doing quite well. But when you talk to businesses, as I do, that are in that residential development, construction or manufacturing or trucking and transportation, they've all said like this has been the worst period since the 2008 recession. And what they're really referring to is the duration, not the magnitude, because the magnitude hasn't been that big. And what we are setting up here is an environment where those sectors, the ones that are particularly exposed to what we call the goods economy, meaning construction, manufacturing, and the ancillary industries of trucking, transportation, logistics, and everything that goes into it, is setting up for further and continued slowdown. So like they've had no reprieve in the last 2 plus years, and there's not really a whole lot of light at the end of the tunnel for them. It's almost like They had 7 years of revenue pull forward. They had 7 years of revenue in basically 2 years. And now they're going on this 2, 3, potentially 4 year stretch where revenues are down year over year over year. The magnitude is really small. They have margin cushion that they've been able to weather the storm to the extent that the Fed holds policy in this place, which they've proven to be, I think, more resilient than after their initial mistake. Eventually, you'll get to a point where margins erode enough, well, they'll have to get rid of headcount, and that'll begin what's likely a more classic recessionary cascade. But for the time being, it does look to me like it's setting up for just a real malaise for the foreseeable future rather than a huge collapse. A more recessionary spiral, which we would define as something that's self-reinforcing, just can't happen until it engulfs the labor market, and that's just not something that we're seeing in the data yet, which has been surprising to me for sure. But when you look at the margin cushion, it makes a lot more sense. So I think we're setting up for a longer, drawn out malaise, which is something that we haven't really experienced in quite some time.
Yeah. So, and I have another question, but David
And
Deere,
and
Gnostic,
and by
what
the
was
way, that's a
everybody?
brutal I mean, stock
Yeah,
investors
I know,
is one
I
thing.
know.
That's a
I
brutal environment for
it,
business operators.
well, and it's also freaking horrible, Eric, if you're a speculator, because speculators like macro volatility. And what you're describing, the drip, 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 that's just freaking horrendous. All right, so I'm going to tee up another question, but then David and Deere, you weigh in. So, Eric, okay, so you made the case as to why the large cap companies with good balance sheets and Mag 7, they should outperform the crappy companies. Okay, fine. So that's one investment conclusion, but either by sector or by country. I don't know if you think foreign markets do better, or I'm going to make it really general. So, what other investment ideas flow out of you? It could be you think the dollar's going down. It could be the bond market's a pair of twos, don't do anything. It could be you think foreign markets will do better than the U.S. market. So, for everyone in the room, so out of this, because no one, how should investors be thinking about this in terms of where that would lead you to think about investing? How, what sort of asset classes, what sort of countries, sectors, markets, et cetera, should they look at?
Sure. So I gave mostly my opinion on stocks, and I focus primarily on the U.S. As opposed to international.
Sure.
As the other thing that jumps out to me would be interest rates. I think that the front end of the treasury curve continues to grind lower. If you look at a 1 year or 18 month or 2 year chart of, let's say, like the 2 year treasury, it continues to make lower lows and lower highs. And I think that continues to be the case because the Fed is going to have to um, gradually lower interest rates. All the vibrance in the economy, the booms and the busts, come from the cyclical sectors. All the inflation comes from the cyclical sectors. So when we're in this drip drip environment of negativity in the cyclical sectors, although it's been slow, inflation therefore has been slow to come down. Um, the Fed therefore has been slow to lower interest rates, but the rates on the front end of the curve are continuing to grind lower when you look at it over rolling 1 year and 2 year periods. And I think that continues to be the case because while the Mag 7 and S&P 500, and people always say if the stock market's going up, that means financial conditions can't be tight, which is ludicrous to me. But the cyclical sectors are really struggling under the current monetary policy regime, which is a difficulty of this, bifurcated or K-shaped economy, where there's parts of the economy that can certainly handle higher interest rates, but certain parts of the economy that really can't. And because that cyclical economy is losing all of its vibrance, the Fed is going to have to, in my view, slowly continue to lower interest rates over time. So the front end of the Treasury curve, I do think, is going to continue to grind lower. The long end of the Treasury curve will continue to have what's been this really range bound momentum for the last, what has it been, almost 3 years. If you look at like the 10 year, goes up to near 4.5 or 5%, then it comes down to high threes, and it goes back up, then it goes back. That's because everyone's waiting for the decline to spill over into the labor market, but it just hasn't. So the Fed hasn't been able to cut rates aggressively. So the long end of the curve can't come down. So the long end of the curve, I think, will continue to be in this range bound pattern. I think it's fair to buy, um, buy 10-year bonds when the rates get to the high end of the range. I'd be careful about pressing it when rates get to the low end of the range until you see more of a break in the cyclical labor sectors. Um, so that's kind of my view on rates. And then the long end of the curve will come down aggressively should that those cyclically oriented labor sectors fall apart, which we just haven't seen yet, which is why the long end of the Treasury curve has had significant volatility. That's my overall view on interest rates. That
That's
covers mostly stocks, mostly interest rates. I do, have a lot less of an informed take on currencies and foreign markets, so I'll probably
that's fair.
stay out of
That's
that
fair.
one.
All right, let me turn it over to my macro friends, David and Deer. You guys got a question for Eric?
So I'm gonna turn it over to Deer because we haven't heard from him in a while, and then I'll go after Deer. Deer, you with us?
Yeah, I am. I'm outside. It might be slightly loud here because everybody's going on lunch. But the I guess kind of two questions for you here, Eric, is the one thing that I wonder as it relates to margins, and this is a bit of a lagging indicator, but is looking at where the output gap is. And obviously, that's a big function of how people measure it, right? You can do it econometrically or use the CBO. But obviously, with a positive output gap, theoretically, it would mean margins are higher in the aggregate, right? Just because, there's more demand than supply. And then moving into kind of the second question is when you look at something like manufacturing output, how do you guys tend to measure that, right? Because I know there's like output per worker, but just given kind of a traditional production function, that's only measuring one function of output being labor, and then you have capital and total factor productivity. Or do you guys kind of just look at the traditional output per worker when you're kind of measuring sectorial, production figures? Those were kind of my two questions top of mind.
Yeah, so we don't look at it as much econometrically. We're looking at it more from a traditional business cycle sequential perspective. So when we're looking at production, we're looking at just the raw number of units and then the raw number of employment. So really more output per unit of employment. That's really how we're looking at the manufacturing production. And then as far as the output gap, again, that's not something that we use. I mean, concept, of course, we understand and we look at it. It's tough because obviously it depends on how you're measuring potential. Not something that plays into our analysis that strongly. We tend to look at things like monetary aggregates versus trend, or aggregate margins versus historical averages, and try and detrend them over time, which gives you a shape that looks somewhat similar to the output gap. So we're probably arriving at somewhat similar conclusions, just looking at it less econometrically, because we're not doing point forecasts. We're not trying to measure, we're not trying to put out a GDP number for the next quarter or anything like that. So we're looking at it more from a just a pure sequential business cycle perspective versus econometrically.
Thank you. And then just kind of a follow up, because it would be interesting to see your take on this. Is even if we kind of look at leading indicators, right? Like one that I've actually preferred to look at, this is a bit on the fixed income side, is the leading economic index year over year and the twos, fives, tens butterfly, kind of looking at the hump, right? Is it more humped, less humped? And then kind of using that to kind of gauge, monetary policy. But when we've looked at like the LEI, which had essentially 100% hit rate up until this cycle, or even the ISMs or these kinds of leading indicators, it seems like this cycle, a lot of that has been very misleading in terms of kind of, are we going to dip into a recession? Is growth going to slow? We actually haven't really obviously seen that until this most recent GDP print. And so, how do you essentially, for anybody on the macro side, kind of position at looking past the noise in some of these leading indicators?
Yeah, I think that's an important question, especially for this cycle. So let's talk about the LEI for a second. So the LEI peaked in December of 21. Let's call it January of 2022. What the leading index is measuring is everyone says it's too focused on manufacturing and construction. Well, that's the entire point. The entire point is that it's focused on construction and manufacturing because it's what it's trying to lead is the employment of construction and manufacturing. So the LEI peaked in January of 2022. Our cyclical index, which again rolls up production and employment for construction and manufacturing, peaked in January of 2023. So there was a 1 year lag time between the peak in the LEI and the peak in our cyclical index. Now, that's really consistent with history. What's been different this time is the magnitude of the decline in the LEI has been enormous, and the magnitude of the decline in the cyclical index has been really small. So, from a timing and sequence perspective, the LEI did not misfire. It misfired in terms of gauging a what was looking like a spectacular collapse in the LEI to what's been a really minor decline in the cyclical um, parts of the economy. The second point is that although it's really difficult to say, and everyone's been thoroughly exhausted by this, we still can't quite say that the LEI has misfired because it continues to fall to new lows. So that still tells us that that cyclical index, while the decline has been mild, is probably going to continue declining. Now, the magnitude is obviously in question because that's what's been called into question this cycle. But it's not like the LEI has turned up and there was no decline that happened. What we've seen is the LEI turn down 1 year later. Cyclical economic um, employment and production peaked and turned down. And now the LEI continues to drop, falling to new lows virtually every single month. So we unfortunately can't really say that the LEI um, didn't get it this cycle, although the lag time has been, beyond anyone's, staying power as far as asset markets. But again, if you talk to anybody in the manufacturing or logistics sector, the LEI has been pretty spot on to what they've been experiencing. What's been wrong about the LEI is not the timing or sequence, it's really been the magnitude. The LEI has declined 25% or something like that, or thereabouts, peak to trough so far. And again, that cyclical index has declined 1%. Maybe more declines are in store for us because again, the LEI hasn't turned up yet, so it's not signaling any bit of an all clear. Um, but that's really what's gone awry. And the reason the LEI has declined so much in terms of magnitude is because of the influence of the yield curve. The yield curve was super inverted, one of the most inverted ever. And the LEI is a factor or the yield curve is a factor in the LEI. So if you removed the yield curve, the decline is less dramatic. We do a little bit of that in our reports as well, looking at leading indicators, excluding the yield curve. And the decline has been less dramatic for sure. So I would say what's been misleading about the LEI this time is really magnitude as opposed to timing and sequence.
David, did you have a follow-up question?
So not in particular, and not in relation to the LEI data.
Yeah, okay, but go ahead wherever you want to go with it, David.
So yeah, no, I was just curious. And by the way, wonderful article. I enjoyed the Substack quite a lot, Eric. Last statement that you had or the last phrase, right? The more blue chips talks, or blue chip and defensive investments like the S&P 500 and or Mag 7 heavy Nasdaq. So long story short, will continue to outperform because of aggregate economy. And my assumptions and what I'm inferring via this is that one, obviously, we're seeing that the leading economy and specifically the cyclical economy is in a downturn, right, since 2023. And by virtue, are you assuming the aggregate economy is going to follow suit?
Yes, the aggregate economy will follow suit. However, the magnitude of the decline that we've experienced in the cyclical economy being 1% from peak to trough over 24 months is not enough. So if the cyclical economy doesn't decline any more from here, then no, the aggregate economy won't turn down because a 1% decline over 24 months is really just not enough. But I don't think the cyclical economy is done declining, given that the leading economy, not just the LEI, but the whole host of leading economy variables are still turning down. Things like building permits have not really turned up. ISM manufacturing new orders remain below 50. They perk up above every now and again, but for the most part, remaining below 50. Hours worked in the manufacturing sector remain pretty low. Home builder sentiment fell, I think, almost back to new cycle lows. So when you look at the broad range of leading economic indicators, they're continuing to be weak on average. Not many of them are collapsing, but they continue to be weak on average, which tells me that the cyclical economy, which again is measuring directly growth and employment, should continue to worsen over time. As the cyclical economy downturn deepens from 1% to 2% to 3%, that will begin to pull aggregate economic statistics lower. But as we stand right now, with just a 1% decline over 24 months, no, we shouldn't expect the aggregate economy to have a spontaneous downturn in the next couple of months here. We really need to see the cyclical part of the economy decline further, and not so much the production components. The production components have declined quite a bit. It's the employment components that haven't turned down. So that's really where I believe everyone's attention should be, and that's the focal point of many of our client reports, is looking at the employment dynamics in the cyclical sectors, the subsectors of construction, the subsectors of manufacturing, as well as the interplay between profit margins, leading employment indicators, and then the aggregate employment statistics for those more cyclical sectors.
Eric, I have to just say, for something which can be a really dry subject, this has been a really amazing discussion, just because the way you've just aggregated it, and I think that's where the real information is, lifting up the hood and getting into the different subsectors. So I really, really am enjoying this. Before we go to Gnostic, I have a follow-up question about housing. So housing is something I've spent a lot of time on, and um, Melody Wright, who's one of the leading housing analysts, and she's on X quite a lot, has her own Substack. She'll also be speaking at our conference next Thursday. She's been really negative on housing, and I concur with the reason. You look at it, as you point out, affordability is a disaster, inventory is now going up, and then you just get to this whole thing where I'm reminded of Stein's law, that which can't go on, will stop. I mean, you look at lack of affordability in some markets now, in other markets with the inventories coming on. I just, I don't want to speak too strongly, but to me, it just looks like a major league car crash is going to happen in housing. Or put it another way, again, this gets back to the dynamic you've been talking about. We could argue about the depth of it or the duration of it. I just think housing is completely stuffed until affordability improves, and that could come by way of prices not going down all that much, and we'll have real income gains for a number of years, or prices are really going to collapse. Because I mean, you probably remember, although it's maybe you read about it because you're so much considerably younger than I am. There was that time I recall in 2007, 2008, on the eve of the housing bust, and there were those statistics about what percentage of California residents could even qualify to buy the own house that they lived in. You just couldn't get from here to there. So I look kind of like the movable object, irresistible force. I don't see how we avoid housing prices. And again, I know it's a heterogeneous market. So if you want to say, well, there's no supply in Buffalo, New York, and houses are cheap, yeah, okay, fine, leave that out. But I'm talking about the markets where you already have issues. I don't see how we avoid a major decline in real terms in housing prices. How would you respond to that?
So I sent you a DM of a tweet that I had, which hopefully you could put up in the nest. So the housing market, I've spoke to Melody a lot. I actually had her on my YouTube channel, had a debate with her, her against Logan Machahami, who's more on the bullish side of
Okay,
housing.
and by the way, Eric, it's in the nest now, so you got it. Go
Okay,
ahead.
very good. So I agree with a lot of the points Melody's making. However, there's in my opinion, some nuances here. So when we look at the housing market, there's a lot of inventory coming in the new construction market, but there's really, really low levels of inventory in the existing home market. The
Right.
problem is that all of the new construction happens in just a handful of states. So I live in New York. We don't have any new construction here. So we only interact with the existing market. But Florida, Texas, Arizona, Nevada, these states have a lot of new construction. So what's up in the nest is a map of the United States and the active listing count by state relative to 2018, 2019. So the states that are in red are the states that have higher inventory today than they did before the pandemic. The states that are in green have lower inventory today than they did before the pandemic. And what you can see is that states leading the surge in inventory are Colorado, Texas, and Florida, with an average inventory that's about 30% higher than it was before the pandemic. But then you have a whole bunch of states, particularly in the Northeast, like Connecticut, that has 76% less inventory today than it did before the pandemic. New York has 44% less inventory. Illinois has 64% less inventory. Again, there's just not a lot of new construction in the market. So the difference today between the 2008 scenario is that in 2008, you had surging inventory in both the existing market and the new home market because you had a lot of adjustable rate mortgages, you had loose credit standards. So there were a lot of forcing functions to get existing homes to market. Today, we don't have any of that. We have all long term fixed. So there's no forcing function to get existing homes to market other than people losing their jobs, which we know that they haven't yet. So what's been happening is you have surging inventory only in the states that have high volumes of new construction, Florida, Texas, parts of the South. Those states are experiencing declines in prices in many areas, which is occurring without any decline in labor, which is a concern. Because if labor does decline, then those prices will fall even more significantly. But if you're in a market that doesn't have a lot of new construction, the only forcing function is labor. And labor hasn't really declined enough yet. So, my counter to Melody when I chatted with her on various podcasts was that I concurred with a lot of what she said, but until there's more pronounced declines in labor, and I'm not even talking about the total labor market. Again, I'm talking about the cyclical labor sectors. Until we have more pronounced declines there, I think it's going to be tough to get aggregate home price data to turn down. You're going to have pockets of home prices weakening in the areas that have really high volumes of new construction, but you're still going to have really tight markets in
Right.
areas that have no new construction until you have sharper declines in just the cyclical sectors of employment. Once that
Makes
occurs, then you'll have more of a forcing function to get some of those existing homes to market, which will bring the total inventory picture up and then potentially lead to more widespread declines in home prices.
makes sense. It's a regional market. Makes sense. Gnostic, my friend, what's on your mind? Please unmute yourself.
Well, George, you just took away the wind out of my sails. That was one of the questions, or a
I'm
component of
sorry.
one of the
Sorry,
questions.
I'm always front running you. Go on. Great, great,
It's
great.
it
Yeah, yeah. Great minds think alike. Great minds think alike. Go on.
it is hilarious, Eric. I'm really enjoying your talk, and I've gone to your Substack and taken a look, and it's nice to see it in that depth. Deer's one of the few people that actually go into things to that same depth. So I love listening to the two of you go back and forth. Question for you: will we actually get into a recession, or is this just going to be a drip, 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 drip until enough turns around that we start going back up again?
Well, that's obviously the $64,000 question. And I think a lot of that has to do with how the Fed responds here. So, should the Fed remain tight, which they look like they are for now, they're going to keep a lot of downward pressure through the economic sequence. and that would greatly increase the risk of downturns in cyclical employment and then recessionary conditions. If the Fed jumps the gun and cuts interest rates really aggressively, and that spurs a rebound in the housing market, and that takes the probability of downturns in construction employment away, then the economy probably would avoid recession. So it's a tough question to answer in isolation without knowing exactly how the Fed's going to respond. Because if I say yes, the economy is definitely going to go into recession, but then for whatever reason the Fed cuts rates 200 basis points over the next 6 months, well, that does change the picture um, quite a bit. Now we're in a dynamic where leading economic indicators probably would begin to turn up on a move like that, and then you'd say, okay, well, are we going to have any declines in employment that occur before those leading indicators turn up and then spread to an upturn in the cyclical areas? So I would say, as it stands today, with what looks like the Fed not doing much other than a couple of cuts for the rest of the year, that is going to keep negative economic momentum through the sequence and increase the risk of recession as we go on throughout the rest of the year, because we will see more margin degradation and then risk of employment. But I'd have to caveat that with, it kind of does depend on the way the situation evolves, and I wouldn't want to box myself into a answer without knowing kind of exactly the way that policy is going to evolve in any unexpected ways. I'm generally not a big watcher of fiscal policy as far as impacting cyclical trends, because a lot of fiscal policy, other than COVID was a big exception, but other than COVID, a lot of fiscal spending happens on these 10-year windows. So when we talk about like the Infrastructure Act being a $2 trillion bill, it's $2 trillion over 10 years, which is $200 billion a year, which usually isn't enough to overcome cyclical forces, COVID being the huge exception where there was multiple trillions in a really short period of time. But I would say that there's some impact here as to how this bill that's going back and forth plays out as well. So I would think that the combination of how fiscal policy unfolds, how monetary policy unfolds, will have some influence on the way the situation goes. But as it stands today, I do still see that negative momentum pushing through the pipeline, and that'll push us closer to recession, not further away.
Nas,
Well, I don't.
yeah, do you have
I think
follow up?
everybody.
Go ahead.
Oh,
Go ahead.
sorry, George. I think everybody here is smart enough and been at this long enough that they understand that there's dynamics in all of it, and your cautions on on this is what I think is going to happen. However, this would change it is very relevant. Do you think that the Fed, under its current tightening process, we had somebody speaking the other day that was very eloquent in how he described how the Fed is tightening, not over dramatically, but constantly just tightening a little bit at a time as they go. Well, a little bit is relevant term. But do you think that tightening, if they eased up on it, would have the same effect as reducing interest rates and spur things to?
Yeah, it's a good question. I mean, I like to look at real money supply, and I don't just look at real M2. I make some slight adjustments to my real money supply calculation to try and capture what I consider to be the most spendable form of money. I like to look at that real monetary measure as the barometer of whether monetary policy is tight or easy. A lot of people will use like the S&P 500, which again is ludicrous to me, but money supply is influenced by the Federal Reserve, fiscal policy, as well as endogenous economic factors. So tightening and easing of monetary conditions generally do fall out in real monetary aggregates. As it stands today, the measure that I prefer to use, which I believe has the strongest correlation to economic activity, that real monetary aggregate is still declining, which means that the Fed is still tight and pushing tightening through the pipeline. If they cut 50 basis points, I still think that would probably would still lead to some declines in real monetary aggregates. So I still think the Fed is tight, and I don't think that they're that close to spurring large increases in real monetary aggregates. Um, so, I think that they have to do a fair amount of easing here to really turn it around, which doesn't look like it's on the table at the moment.
Right. So, Eric, and I think we're going to close this from fairly short. If anyone has another question, please raise your hand because Eric's been very generous with his time. We're going on an hour and 15 minutes. Eric, as one looks around the economy historically, I mean, they always say, recessions don't just happen. There has to be an imbalance, usually something. So whether you look at various sections of the economy, you could have inventory correction, you could have a housing bust, you could have automobiles excess, whatever, capex boom, with too much whatever hangover from that. And as you look around the private sector, yeah, you see all these hot takes on Twitter. Someone shows a credit card number or this or that, but BNP, buy now, pay later. Those are all like little things. They don't really matter in the overall scheme of things. And so, if you look at financial obligations, serviceability, and all that kind of stuff in the private sector, it looks kind of okay. Yeah, there are parts that aren't okay, but in the aggregate, it's okay. But so when I look around, and this is just me, but there's a question here. I'll get to the question. I look around and I say, where the real excess is now? It's at the sovereign level. It's the federal government. They're the ones that are totally out of whack. So agree, disagree, and how does that inform your outlook?
Well, I agree that it's out of control at the fiscal level, but they are the central taxing authority. So if they have issues, they could theoretically push the issue back to the private sector by taxing the money away from them. Um, so yeah, I mean the excess clearly is on the fiscal level in terms of how out of control the spending is, but I like to look at macroeconomists by trade. So you look at some broad accounting identities, and we have huge budget deficit, and there are segments of the economy that demand capital, and there are segments of the economy that supply capital. So the government's demanding a lot of capital by running negative savings or borrowing. Um, and then the private sector is supplying capital because the private sector is saving. But the government sector's dis savings is higher than the private sector's savings. So the government's running, 6 or 7% budget deficits. The private sector is saving 3 or 4%. The difference comes from the fact that we run a trade deficit.
Right.
So what's been ironic about the administration's policy is they came out with a initial stance of we're going to reduce the budget deficit and close the trade deficit, which would have worked if you did a one for one swap. But what's clearly panning out is they're widening the budget deficit and also trying to close the trade deficit. So what that means is that's going to force savings onto the private sector, which either means higher household savings and lower consumption or lower private domestic investment. So corporates having to save more and invest less. That would lead to a recessionary scenario. Um, which is why I think that ultimately the way this is going to shake out is it's going to be a bigger budget deficit and a wider trade deficit. But to the extent that these tariff walls are large enough and truly sticky enough, if you run bigger budget deficits and smaller trade deficits, the difference is going to come out of the private domestic economy, and that would be recessionary. Which is why
So
I think that ultimately the trade deficit's probably going to get wider, not smaller.
wait bad joke attempt coming here. So you're saying this whole Doge thing was a scam from the get-go?
Well, I'm not saying that. I'm just
I
saying.
no, but you can't do it. You have a real busy. You have clients. I can say whatever I
Yeah.
want. I've been saying that since November 6th. So let me put it to you this way. I learned this trick from Peter Lynch. I've been maintaining that Doge has been a complete scam from the beginning because the numbers don't add up. Eric, am I a bad analyst?
Well, all I'll say is that it certainly looks like the budget deficit's going to get bigger, not smaller.
Oh,
Um,
oh, you
and,
should be in the administration. What a diplomatic
yeah,
answer.
and to the extent that the budget deficit gets bigger, um, unless you want the difference to come out of the private sector, you're going to have to run bigger trade deficits to finance that.
We're
Um,
good. So the man said, "We're going to need a bigger trade deficit, just like in Jaws." Yeah, okay, I got it.
And the problem with the budget deficit, and I really want to stay clear of any political issues, but I post things like this, and I just post raw numbers. Is Doge went in there and did a whole bunch of around the edges type stuff. Um, but the only thing that's relevant as far as the budget deficit is Social Security, Medicare, and Medicaid.
Right.
Um, if you're not going to go near those things, then everything else is
Yeah,
completely irrelevant.
you're not serious. Exactly. Exactly.
I do have to jump here, but just
All
on this
right.
topic, I do want to throw one chart in the nest just on this topic because I think it's pretty. I just passed it over to you.
Yep.
Um,
I'll put in this. Keep talking. Keep going.
what this chart shows is the changing breakdown of the U.S. federal budget. So it's out of a percentage. So 100% is the total budget, and what it's showing is that in 1955, 16% of the budget went to social benefits, which are basically Social Security, Medicare, and Medicaid. 65% of the budget was consumption expenditures, which is defense, wages, government wages, things like that. 7% was other transfers, which is basically transfers from the federal government to the state. Most of that is Medicaid. So you can kind of lump the blue together with the green as far as the three big entitlement programs. Then you have the gray, which is interest, and then subsidies, which is like subsidies to farmers and oil companies, which a lot of people talk about, but as we can see, it's pretty much irrelevant. And you can see how it's changed over the decades to we're at the point now where the government is basically just a giant transfer mechanism of social programs. And I'm not saying that there's anything particularly wrong with social programs. You just have to tax for it if you want to run them. Um, but we're in a situation now where 50% of the budget is social benefits. It's really 65% when you take into consideration the other transfer payments, which again is transfers from state federal to states to run their Medicaid programs. So 65% of the budget is basically the three entitlement programs. Then you have interest payments, and that gets you to 85, 90%. So, like when Doge went in there, unless they were going to tackle those three programs, you could cut 100% of the budget elsewhere, and it really wouldn't make a dent. So, this is something that we'll have to deal with, which we don't seem to have an appetite for.
Wow, Eric. Honestly, I'm so happy with this space. I always talk about company, earnings come out better than expected, worse than expected. Like you've taken probably what would normally be a very dry conversation. This has really come alive for me, and so this has been fantastic. I salute you. I wish you good luck with the New York sports teams. I
I'll take
also
what
I
I
also
I'll
I
take.
also hope that you'll come back before the year is over and we can see how things moved along. This has been great. And again, everyone, you're Eric, you're what, EPBresearch.com, I think, is that right?
That's correct.
Yeah, and everyone knows where to find you on Twitter. So thanks again, Eric. This has been awesome. I don't think your Knicks have a shot tonight, but that's not. Or was it tonight or tomorrow night? I lost track of. Well, it's tomorrow night. All
Yeah.
right. Good
Thanks,
stuff,
George.
Eric. All right, you
Yeah,
be
glad to
good.
be
Take
back.
care. Okay.
Anytime you'll have me. Thanks.
Yeah. Bye, everyone. Thanks. Take care. Bye bye.